As April begins, so does a new financial year. But what's changing in the world of taxation this time? From revised tax slabs to basic concepts of taxation, here's everything you need to know. This topic is related to the economy subject for UPSC. Why in the news? From April 1st, sweeping changes in India's income tax regime came into effect, offering significant relief to nearly 1 crore taxpayers. Union Finance Minister Nirmala Sitharaman's budget 2025 proposals, which include a substantial hike in the tax exemption limit under the new tax regime, are expected to benefit millions by lowering the tax burden. In this context, let's familiarize ourselves with the key features of the new tax regime and some basic concepts of income tax. Key takeaways. Firstly, the most important change in the new tax regime is the increase in the tax exemption limit from 7 lakh rupees to 12 lakh rupees under the new tax regime. This move ensures that individuals earning up to 12 lakh rupees annually will no longer have to pay any income tax. For salaried individuals, a standard deduction of 75,000 rupees will continue to be applicable. This means that an individual with an annual salary of 12.75 lakh rupees will effectively fall within the tax-exempt bracket, owing to the deduction that lowers their taxable income to 12 lakh rupees. While the higher exemption slab is a boon for many, it is essential to note that individuals earning slightly above 12 lakh rupees will not be entirely exempt. For instance, someone with a taxable income of 12.1 lakh rupees will incur a tax liability of 61,500 rupees, calculated as follows: 5% on income between 4 lakh and 8 lakh rupees, 10% on income between 8 lakh and 12 lakh rupees, and 15% on the amount exceeding 12 lakh up to 16 lakh rupees. Lower TDS on rent. Another key change is the increase in the TDS, or tax deducted at source, threshold on rental income, which has been raised from 2.4 lakh rupees to 6 lakh rupees. This revision aims to ease the compliance burden on smaller landlords and property owners. So, there are two types of taxes. First, we have direct taxes. The Central Board of Direct Taxes, often referred to as the CBDT, is responsible for administering these various direct taxes. Now, this includes income tax, corporate tax, securities transaction tax, and so on. Essentially, direct taxes are paid directly to the government by individuals and corporate entities. Indirect taxes. An indirect tax is applied to the consumption of goods and services. The government collects this tax from the sellers and retailers of these products and services, who then pass the cost on to the buyers. When you buy a product or service, you not only pay for the item itself, but also the tax. In this way, you are indirectly paying the tax to the government. Sales tax, custom duty, GST are examples of indirect taxes. Difference between ITR deductions and exemptions. Understanding the distinction between ITR deductions and exemptions is crucial for maximizing tax savings. While both aim to lessen your tax burden, they work in distinct ways. Deductions directly chip away at your taxable income, lowering the amount you pay taxes on. Think of it like shrinking the pie before anyone takes a slice. Examples of deductions include work-related expenses like professional fees, travel costs, or depreciation on business assets.